Thank you so much for joining, James. I really appreciate your time. And I know we just kind of got connected real quick on BP, and here you are. And I'm just so excited to hear about, your story and kind of what you've been doing. So,
Sure.
let's jump right into it. James, can you tell us a little bit about yourself and kind of like what you've been up to lately?
I'm a multifamily investor. I syndicate money from private investors, and we raise money and we go and buy specifically value add deals. Right now, we're focusing on San Antonio, Texas. We have almost like 800 units worth almost more than $50 million. And we have been rocking it. We have a bunch of investors who has been with us since my first deal, and we have been keep on buying, but we always make sure that the deals make sense, right? And recently we won a Property of the Year award for San Antonio for best rehab, which is a huge thing because a lot of Greystone, Capstone, all the big property management guys, they didn't win, and here we small property management company won that award.
Fantastic. That is a good, brief, but good introduction. So let's kind of rewind back a little bit, right? I just wanted to find out a little bit more of kind of the genesis of real estate. Why did you go into real estate?
Well, I mean, I think all investments are good as long as you find the right guys, and if you find the right education, right? For me, I tried a lot of things. I tried with stocks, but stocks is it's a joke for me. Every time I go in, I lose 20,000 within a few minutes or few days. So it's like stocks plays with humans, the fear and greed, and it plays with me a lot. And I think I have to play for a long term, but I'm just not. I mean, I like to monitor my phone to see, what's happening with my stock every few seconds. So there's no peace in mind. So I gave up on stock because I'm losing money and there's no peace, right? So bonds is too slow for me, and that bonds I think is not for the young guys, right? What's the point of doing bonds when it goes so slow, right? Real estate was really fun. I mean, the control that you have in real estate to create your own destiny, it's very critical aspect for me because I think everybody's thought that you control your own life, right? So in stock someone else control your own life. I mean, there's a lot of champions right now in stock market, but everybody's a champ in the bull market, right? So same thing even in real estate. For the past 6-7 years, whoever doing very well in real estate may not be doing really well actually in a downturn, but apart from that aspect, I like the control aspect of real estate. So it gives me my own control to determine my destiny in real estate, and that's where you can put your own sweat equity. You can use a lot of creative methods. It's a real business where you control. So that's why I like real estate.
So a dwell listener might be listening to this and thinking, well, James, you're a big guy. You've got 800 units under management. You've got like 50 million, assets under management. You're a big boy. I can't even relate because you're so up there. One, what would you say? What would you say to that listener? And you can use that opportunity to kind of tell us, your evolution into multifamily.
Well, no, for me, it's like no matter how big you are, everybody is just a normal person, right? And at the day, we started at a humble beginning. So there's no real big things about me. I mean, I'm just a normal guy. Same thing with people owning 300 million, $400 million assets. But I would say that one thing that could have separated them with the guys who are like trying is the guys who are trying has not changed their mindset yet. They have a lot of external influence there's not many deals out there. Do you think so?
I don't think so.
Okay, good,
I see
good.
deals
Because
all day, every day.
a lot of people think that there's not many deals, the market's already peaked and there's nothing for me. So of course there's no deals. But if you think there are deals, of course there are deals. It's all come down to the mindset. So I don't know whether did I answer the question, but I
Yeah.
think
So
I was more relating to not.
okay, so have you always done multifamily, or did you actually grow
Oh
into it?
no, no, I grew into it. I started with single family. We bought like in 2013. We start buying rentals, buying a strategy called double closing, where you buy, reposition, refinance, and rehab on single family. We bought like we did like 13 single family homes, four of it which we still have right now. But out of 13, two were flips, and I promised myself not to do any more flips because it's just too much work for the amount of money you make, right? So two flips we gave up after doing that, and we did 11 rentals. Out of 11 rentals, six of it was zero cash out of pocket. In fact, a lot of it paid me back. So we started in multifamily. We started in single family, and then we moved on to the multifamily as a scale because multifamily is just you're able to leverage your time better. You're able to force appreciate multifamily compared to single family. Like no matter whatever you can do, you can jump up or down, or the sun can come from the west. It's all depends on your comps surrounding it, right? Um, but for multifamily is different, right? You can force appreciate it. So the concept of you controlling your own destiny is amplified on the multifamily compared to single family, right? Because multifamily you can tweak, you can be very creative with increasing NOI, increasing income, reducing expense, or with financing strategy. There's a lot of creative methods to do financing. So there's a lot of things that you can do in multifamily, which would be very creative methods, and you control your own destiny. So end of the day, it's all coming back to you controlling your own destiny.
Fantastic. So I'm that young guy listening to you, and I want to be James, right? So you kind of skimmed through it. So you bought six of your, you said 11 rentals without money. You actually got paid. So
Hmm.
if I'm a young guy listening to, or a young girl listening to this, I'm like, I want to do that. So can you just
Okay.
take one case study of those six that you actually didn't put your own money down? So if I'm a dual listener listening to this thinking there are no deals out there, I can't go into multifamily, I can't even buy a rental. How did you do that deal? How did you find it? How did you fund it? What were the numbers?
Well, I mean, in single family, um, three or four strategy is very common. Something called wholesaling, where people flip contracts, right? You buy here and then you give it to the investor and you make money. So there's a lot of skills involved in doing that. I really like the skills that wholesalers bring to the table. There's another one which is called flips, which is basically you buy a house and then you flip them in a few months, after you fix it up, and you after you fix it up, you basically sell it back to an end user, right? So the strategy that I use is to buy rentals and do a longer term flip, which is more than 1 year because of your tax advantage. Right? More than 1 year, it becomes a long term capital gain. However, doing that strategy in rentals also give us an advantage of doing something called double closing strategy, which means you buy using hard money lending, and then you fix it up. You borrow the rehab from the hard money lending, you fix it up, and then you refinance it into a normal conventional Fannie Mae house loan, 30-year house loan. So basically, the strategy it works. I'm not sure why it's not explained anywhere else, but I'm going to explain to you guys because I think it's a very simple strategy, but not many people explain it, or maybe it's still a secret. I do not know why is that.
We love
So,
secrets. Tell us.
so I'm sure your listeners are familiar with ARV, which is after repair value. So let's say you buy a house, you find a house which is ARV. That means you find a distressed house, right? Distress can mean anything, right? So can be the owner would just want to get rid of it. He's stuck in some mortgage issue or some loan issue. He just want to get rid of it. That's also called a distress, but the seller's distress. Sometimes the property is distressed. There's foundation issues or it is abandoned. So you buy a property which has reduced in value. So basically, this is another power of single real estate, right? Where you can buy something at 20% below cost, but you can work it up and push it up, 20% above the comp surrounding it. So basically, let's say you buy a house for, let's say you buy a house with the ARV of 100,000. So basically, the potential of that house after you fix it up is 100,000. But the right now it's, it has foundation issue, right? For some reason, the seller said, I'm going to sell it for 60,000. So basically, you're buying at 60% ARV, right? 60,000 divided with 100 is 60% ARV. So, but for you to fix it, you need to fix it. Let's say 15,000 to fix it up. You need to fix foundation. You need to rehab it. So now you are getting a hard money lending at 60,000 plus 15,000 of repair. So basically, your value that you're putting in is 75%, right? So 75,000, 75%. So basically, after you fix up all your money in is 75 percent in, and your hard money, let's say they give you a loan of 70% ARV. So basically, what happened is that 75% you have additional 5% extra in your own money into the deal, and 70% was given by the hard money lending, right? So when you go and refinance with the Fannie Mae, they're going to give you a loan of 75%. But the 75% is going to be based on the new appraised value. So they're going to be based on 75% of the 100,000. So basically, they're going to give you 75,000, right? So you see, what's happening is you had a loan of 70,000, but you're getting a new loan of 75,000, which means basically 5,000 additional there, right? Um, so basically, you are going into the deal because now Fannie is going to pay back the hard money lender, right? So we the loan is 75,000, what you owe is 70,000. So basically, they pay off the hard money lender and you have additional 5,000. So that 5,000 could be the rehab money and all that, right? So basically it becomes a zero cash out of pocket if you buy it below certain percentage. So my calculation was like below 66% ARV. If you're able to find a deal below 66% ARV, that 70% hard money lender and 75% of Fannie Mae would almost give you zero cash out of pocket. And
Fantastic. Thank you.
yeah, the better deal you buy, of course you get, the Fannie Mae is going to say, I have more money now. I'm going to give it to the hard money lender and they might pay you back. But there's ways to do the rehab money, slightly more and, all that when you refi, and it's either be zero or they'll be paying you back. That's called a
Fantastic. A
double
double
closing
closing.
strategy in single family.
Fantastic.
Does that make
So,
sense?
yes, absolutely. Absolutely. So, now you were doing this, you were doing this successfully well, but there was a
Mm-hmm.
transition from single family to being, to winning awards in San Antonio, having the best apartment and, buying
Mm-hmm.
these bigger buildings. So in the beginning, you also mentioned mindset, right? So can you kind of
Yeah.
talk us through how you made that shift from single family investing to multifamily, and how did mindset play a crucial role in helping you make that transition?
So the mindset has always been think bigger, right? How can you think bigger? How can you move to much larger scale? And single family, we realize it quickly. I mean, managing 11 single family homes is not easy, right? We have to manage. Like, we had like every 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 single family at their own insurance, right? So, and insurance expire at different time because you bought the house at different time, and even to scan and print and sign the insurance, it takes a lot more time than what I'm doing on my multifamily. So we know single family is not scalable. It takes a lot more work, but it's quick. You're able to go and find it from MLS. You can buy it from mom and pop. It's a very good starting vehicle because it teaches you the fundamentals of real estate, right? How do you screen tenants? How do you find tenants? How do you collect rent, right? What are the system, rent roll? What is a rent roll? So I think it's a very good place for everybody to start in single family. I know some people say just jump directly into multifamily, but I think they can't do the difficult multifamily deals, right? You can do the easy ones, which is basically you buy day one cash flow, after 5-6 years, you get a lot of equity build up, right? But if you want to do the difficult multi-families, I think it's a very good start to start in single family because single family, managing tenants, managing contractors. When you do like a rehab in single family, you are basically managing a project, right? So you're learning all the skills that leads to multifamily. The difficult multifamily. I'm talking about value add multifamily, right? So I think it's an important place to start for single family. I think we don't regret starting in single family, but we also quickly realized that single family takes a lot of effort and a lot of time, and keep in mind single family has a lot more maintenance issues and all that, which is comes out from your bottom line, whereas in multifamily all that is part of the expense, right? And multifamily you're able to put in your own property management stuff and all that, so it gives you a lot of leverage. So the mindset is basically, I know I'm going to go to multifamily, but I would say that the help I get from equity build up in my single family. I build up with the 11 houses. We build up like 400,000 of equity. So that was my launch pad for multifamily, because in multifamily you're playing slightly bigger money, and when you want to syndicate, we always put money into our own deals. So we put a quite number of money in the beginning, and gives us a bit more comfortable to have that launch pad, right, with the single family. So
Fantastic. Okay. So the second, so that's
sure.
the one aspect of making that transition from single into multifamily.
Mhm.
The
Yeah.
other stopping block that a lot of investors face is the capital, right? You talked about syndicating. So how did you, so you had the launching pad with the equity that you had built up from all of these rentals, but then how did you end up, one, finding investors where you could pull together to syndicate a multifamily? And was that challenging for you? And if it was challenging, how did you overcome those challenges?
Well, a lot of times after doing, such a good job in my single family, a lot of people get to know me because, when you go to meetups and all that, you start telling people, hey, I did 11 houses, 6 houses was free. Wow, this guy is different, right? So people start to find out a bit more about you. And you start telling about yourself. You have to in real estate, you have to brag about yourself, of course reasonably, right? Whatever you have done, really, then you can brag. But keep in mind, we are at a time right now where it's easy to raise money, but it's hard to find deals. We are the sellers market, and market is at, we have had this expansion market cycle for almost like what, 5 to 6 years now. So right now, money is not the difficult part. If you find a good deal, and people will be able to help you raise money. So I think capital, there's tons of capital looking for this small number of good deals out there. Not all deals are good deals, okay? There are a lot of deals. People are doing deals. I know everybody claim they do deals, but these are the deals done when the tide is high, right? But when the tide become low, you do not know what's going to happen to all these marginal deals that a lot of people are buying, right? So yeah, that's my answer to that question.
Awesome. So you've got the multifamily stuff going, but I
Mhm.
think it'd be very interesting for our dual listeners to actually talk about one of the case study, maybe the one you won the award for in San Antonio. Can you tell us,
Oh,
kind
cool.
of the numbers, the story behind it? I really love what you talked about on Bigger Pockets. So maybe elaborate on that story, how you acquired control of the assets, then refinanced it, and just give us the whole spiel. We love numbers.
Sure. Can you hear me now? Can you hear me clear and
I can
clear?
I can
Because
hear
I
you
think
just I can hear you just fine.
okay, because you lost for a while. So basically, we bought that deal off market. So this is the same strategy we use in our single family, right? Where we buy deals off market, right? So when I talk about buying, doing double closure and all that, buying, when remember I talk about buying a house 66% ARV. Everybody in the market is looking for that kind of single family home, right? Where you can find really good deals and all that. But we were able to find that kind of deals by deploying our own strategy, off market strategy, to work to get access direct to sellers. So basically what we did is, even on multifamily, we start doing our own marketing to find sellers, to find really good deals. And so we did, for this property was bought using our, off market strategy. So we bought it at market price, but I know the upside is huge. Like, we bought it at 6% cap rate, which is the way that comms are being measured in the multifamily. And then but we know once we put in improvements into it, we bought that at 6.9 million. We put in like 1.4 million dollars, but it was a huge project, right? So we spent 1.3 million dollars in 12 months, and we increased the value to almost 13 million in 12 months. And so imagine 6.9 plus 1.3 is almost like what, a 8 point something, right? And then so there was additional almost to $5 million upside built in within 12 months.
Wow.
So now coming back to the second strategy, right? Refinance, right? So now we're going to refinance. This was an agency loan, but we assumed the loan. There was another 4 more years left. So there was a penalty of almost like 4 to 500,000 penalty into it. But that's okay. We pay 4 to 500,000 and you put into a 10-year loan or 12-year loan, into a long-term loan, and you're getting another $4.5 million on top of the penalty. But that's a better strategy for long term. And yeah, that's what we did. 6.9 plus 1.3 increased to 13.1. I know you're scratching your head, right? So,
Wow, that's fantastic. I mean, first and foremost, congratulations, because that is, you don't hear that every day. So that's fantastic. That's awesome. That's just awesome.
yeah,
So are you
yeah.
also located in the San
Mhm.
Antonio market?
Well, I am in Austin, but I buy in San Antonio, right? So it's like 1.5 hour drive, so it's not bad. But we started our single family in San Antonio, and then just continued over there, right? Austin is an awesome market. It's just I can never catch to the price here. The houses, the apartments here, it was 40 a door when I start looking at it, and I say it's too expensive because everybody was buying at 30, 35, and after 2 years it went to 60 a door, and I said, wow, that's still too expensive, right? Everybody's doing 55. So, but after 2 years further, it went to like 80 a door now. So like, it's very hard for me to catch Austin prices, right? So I gave up on Austin for now, unless I can find some really good deals. And
Makes
we
sense.
focused on San Antonio. Yeah,
Makes
yeah,
sense.
correct.
So, thank you so much for sharing that with us. But you were
Hmm.
mentioning that you use some off-market strategies, right? So are you talking about like direct mail? I mean, what kind of, because a lot of people say, well, I don't know how to find off-market deals, or, I don't know how to start, looking for off-market deals. So, I mean, from a residential perspective or for an wholesaler,
Hmm.
it's pretty straightforward. You go to list source, you grab a list, you send some mailers out, 3letters.com. But for
Hmm.
apartment buildings, how was that different for you guys?
It's the same thing as what you guys do for houses. But one trick would be, a lot of apartment owners, they basically hide behind LLCs, whereas single family home is all listed on mom and pop's name, right? So you have to do skip tracing to find the owners behind it. And even after you do that, you still would not get people to respond to you, because a lot of them, they want to go to the brokers, right? But they are people who don't want to go to brokers. They are people who like you. If they like you, why not they sell to someone they like, and they save on brokers commission, right? So yeah, that's how you do it in multifamily as well. You do direct contact with the sellers, at the same time build relationship and try to get them to sell to you.
Fantastic. Thank you so much for sharing that. So I wish I could keep talking to you, but we definitely rolling into the quick round, into the dwelling round.
Sure.
So these are going to be like quick questions, quick answers.
Okay.
You ready?
Sure. Go ahead.
First question. What makes you, James, unique? What is that differentiating factor that separates you from the next guy or the next girl?
Um, I would say off-market strategies. Even though I used it in the beginning, the first two deals, which is almost like about 174 plus. My first one was 45, so almost 230 units was bought off-market, and I can continue to do it, but it takes a lot of work. So the second unique strategy is, I like to outwork people, right? Which means anybody who has persistence and grit, if you outwork everybody else, if you wake up very early morning and then you work hard, you will be successful. And yeah, that's
Fantastic.
my specialty. Yeah.
Awesome. Second question. What was the last book that you read, and what was the one thing that you got from that book?
Last book that I read. Probably Jack Canfield, the Success Principle.
Fantastic. What was the one thing that you learned?
Oh, I learned many things, So I would say end of the day is all up to the mindset. As I said, if you think there's deals out there, they are deals. If you think there's not, it's not. And all the books talks about the same thing, right? So a lot of self-motivation books, it's all coming back to discovering yourself, your potential.
Fantastic. Last question. So you've got all
Mhm.
this activities going on, you're managing your assets, you're sending out mailings, you're doing a ton
Mhm.
of stuff. What do you do for fun?
What do I do for fun? I do scuba diving. Yeah, even though I didn't dive for some time, but I do scuba diving and try to spend time with the kids as much as
Awesome.
possible, because as entrepreneurs, it's hard sometimes we overwork ourselves.
Yep,
And
yep, yep.
sometimes work is fun too. Analyzing deals is fun, especially
Absolutely.
finding that small value that people didn't see, or negotiating a certain deal with the off-market guy. That's like at the end of the day when you close, it's like, wow, you did something that nobody else have done. So that's gives you a very self-fulfilling feeling.
Awesome, 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 awesome. So thank you so much, James. It's been an absolute pleasure. I've learned a ton from this session. So I really appreciate your time. Thank you so much.
You're most welcome. Thanks for having me here.